Whoa! Jeremy Siegel is saying the 60-40 portfolio won't cut it anymore. Interesting. I follow Jeremy Siegel like crazy, so what he says, I listen. A number of you have sent me through this article. Much obliged. Again, remember, I try to archive everything nowadays. So archive.today or archive.ph. As you can see up here is the link, archive.ph. If you can send that to me, so that way you can eliminate the doomsdayers and their clickbait stuff on the ad revenue. So if we're not looking at CNBC here, we're looking at archive. That means there's no ad revenue on this article. And I'm taking on CNBC. I don't mean to, but all these guys, the naysayers, on both the left and right. I'll share with you on the right here shortly. Dateline February 8th. All right, so let's see what Siegel says. Hindsight is 2020 on the 60-40 portfolio. Siegel is professor of finance at Wharton, University of Pennsylvania, is encouraging investors to consider alts to the traditional 60 stock, 40% bond allocation. The latest developments in their mission are two models that made up entirely of exchange-traded funds, the Wisdom Tree Global Equity and the Wisdom Tree Longevity Model Portfolio, for which Siegel advises on. There are two funds offered on TD Ameritrade's Model Market Center platform. Take inspiration from two of Siegel's books, Stock for the Long Run, which I have back there, and two. I think, was it two? Yeah, I think I got two iterations. I think one was in 96, the other was in 2008, I think. And then The Future for Investors. Siegel says, we believe the old 60-40 model just won't be able to cut it anymore. The environment of low interest rates is not going to change. And notes that the dividend yield on the S&P 500 is actually higher than the yield on the 10-year Treasury, which is at 1.5. How is that going to give you enough income? The Siegel Wisdom Tree funds will try to solve for that problem by offering low-cost, high-yield investment strategies that highlight one of his main arguments, that stocks may be subject to volatility in the short term, but ultimately have less long-term volatility when compared to bonds. That drives me insane. So if you look at a chart, you see the long-term stock of bonds, the volatility of bonds gets leveled off, so it looks like this, and it doesn't look volatile. And if you look at bonds, you say, and at the end of the day, though, the problem with the idea that stocks give you less volatility or less risky than bonds in the long run is that you never hit the long run. The long run is never here. What was the long run 30 years ago is now, but now is not. We are in the short run now. I hate to say it, but I don't care what happened 30 years ago because I was 19 years old, for heaven's sake. I care what happens in the next 30 years. When I'm 79, I won't care what happened when I was 49. I care what happens in the next 30 years if I'm still right. You see what I'm saying? There is no long run. You never reach it. There's always a short run for markets, always, and thus stocks are always more aggressive and more volatile and more risky than bonds. It will never change. This drives me crazy. Anyway, so that's why we recommend the 75-25 as the equity fixed income allocation. We think it would be the best way for those approaching retirement to establish their assets to get enough income and gains to maintain spending throughout retirement. Central banks have been partly to blame, but he also cited other powerful demographic factors such as the aging population, longer life expectancies, a broader inclination to avoid risk, and slower growth overall in the overall markets as additional depressants for bond yields. All these factors are going to keep these interest rates at these levels for a very long time, and you cannot survive on a 1.5% nominal yield. In fact, he says, look at the TIPS yield. The real interest rates are negative right now, and that's real after inflation. It cannot maintain spending streams at all. Dividends on stocks are going to be the new bond in terms of thinking about retirement. I completely agree. They don't let comments on here. Actually, it says read more. We got more on this? Let's see here. Oops. Okay. I'm not sure what happened there. Read more. Did I click on the... Okay, I just clicked on the article. Okay. Anyway, so what I want to say here is that I find it interesting because I'm on a conservative website where you can actually post blogs, and which I enjoy, and I like hearing from my side, the conservative side. Rip me up when I talk about how we need to expand Social Security and the wealth tax and whatnot. It's interesting. I disagree with their assessment about Social Security and the wealth tax. I think those days are gone that Republicans should revisit all this, but whatever. But the interesting thing is the people on the right, where the people on the left are worried about climate change, the people on the right are worried about hyperinflation and worried about EMPs and stuff. And it's actually sad to see. This one guy said, "Oh, I don't know how you can say, freaking Social Security, we're gonna have hyperinflation." I'm just like, where do you get that from, man? I mean, all the economic textbooks, not one of them ever predicted we would be where we are today. Not one did. With low unemployment, low interest rates, moderately low, it's not even that bad, but moderately to lower growth for sure. I wouldn't even say it's moderately lower relative to historic norms. I'd say after World War II, sure. But, relatively speaking, 3%, 2.5% to 3% growth is pretty good. But anyway, we'll just say moderately on the low end of growth. Low interest rates, low unemployment, low inflation, low bond yields. Not one textbook predicted that. But the debt, Josh. Then we just turn our focus to the east and we look at Japan. Their debt to GDP is at 240%, my friends. The U.S. just breached 100%, where I think we're 106%. All right, but the Japan has been like this for decades now. And there's no inflation. There's no extraordinary growth. I think they're at a zero interest rate policy for sure. And there's low unemployment. So, you can't say, well, we're going to have hyperinflation, and then I turn and look at Japan and say, how come they've avoided it? And they can say, well, the demographic trends, okay, well, 20 years ago, the demographic trends weren't what they are now, and they didn't have the hyperinflation then. The U.S. doesn't have, we're the same thing. In fact, if anything, we'll have a little bit more growth, which would mean our interest rates are probably a little bit higher than Japan, but certainly not to the extent of hyperinflation. It's silly. The only hyperinflation economies are ever from the government. Without question, in terms of stagnation, Nixon, Carter. I blame Nixon more than I blame Carter, by the way. Zimbabwe, Venezuela, Iraq, Cuba, all those places. Russia, they all have nuts in terms of economic situations. Thus, they have hyperinflation. But it's not because of government spending. If it were, then Japan would be in hyperinflation. It's not. So anyway, I find this interesting about Siegel. Obviously, he's making a pitch for his wisdom tree funds, and I don't know anything about it. I don't care, frankly, but I agree. A 75 to 25% stock to bond portfolio makes sense to me if you need it. But I'm going to share with you another article. Well, you probably won't. I'll share that here with you shortly. So, as always, don't forget to comment, and we look forward to seeing you next time. Thanks now.